on it.
Yeah,
There we
there it
go.
is.
Okay. Good morning in TV land. This is the meeting of the Board of Trustees of Trust Funds for Friday, February 23rd. I will call the meeting to order, and we'll begin with, I guess, a roll call because we're still remote in Florida. Mr. Weeks?
Present.
Mr. Levinson?
Present.
And the chair is present. I will, next item is the approval of the minutes of our last meeting on January 18th. I will entertain a motion to approve.
So move.
So moved.
A second. Any corrections, additions, deletions? Hearing none, I'll call the question. Again, by roll call. Peter?
Yes.
Dana?
Yes.
The chair votes yes. Okay, so in the 15 minutes before the TD people get here, I'd like to discuss the scholarships summaries that we received through Peter's efforts. And I guess the first item is part of the materials you received is a proposed press release relating to the scholarships that Stephanie put together and sent it over to me this week, and I wanted to make sure you're comfortable with that before I give her an okay to send it out.
Yeah, I have one,
Sure.
or actually two additions. We talk about private schools.
Okay, where are we now?
You're in the first paragraph.
Oh, and the last sentence. Okay, yep. Eligible Portsmouth students attending private schools.
Yeah, we should add governors. And we should add St. John's.
Prep.
Yeah. Because I know both schools have Portsmouth residents attending.
Okay. Is that, were those the two, or did you have another change you want to make?
No, that's all I.
Okay. Any,
I'm just curious, is there a geographic requirement that we have to consider? I mean, what if they're going to a private school in California, but they're a Portsmouth resident?
well, according to the change that we made, they just need to be going to an accredited high school somewhere,
Right.
you know.
Maybe we're better off just not listing any schools, just saying attending private schools and homeschools.
How do you feel about that?
I like listening to schools.
Okay.
Or in Dana's point, or any other accredited high school.
That's good. That'll cover it all.
Okay. All right. Other than those changes, I guess I'll entertain a motion to release this.
So move.
You hear a second? Okay. All in favor? Peter?
Yes.
Dana?
Yes.
And the chair votes yes. Okay. Now, scholarships themselves, I don't know if, I know Peter was able to go through it because he mentioned it briefly before the meeting started. Have you had a chance to look at these summaries off of the high school's webpage, I guess?
Yeah, how they're all listed, I have, yes.
Okay. So part of the message from Stephanie Secord when she sent me this draft release was that she's also created a link from our website to this as well. So people who go to our website looking for scholarship information will be able to access this. I think going through every one of these is more than we can do today. And I guess I want to get your opinions as to whether we want to go through the effort of pulling all the documents associated with each of these to verify that they're correct or not. I did find a couple points that I thought should be made in the community scholarships and in the Mortimer scholarships.
In regards to,
So on the community scholarships, they didn't get whoever drafted this didn't get a copy of the letter that we sent to the principal of the high school saying that they're now not limited to New Hampshire. So if you look at, well, I numbered my pages, but on page 15, they start the community ones with the Community for the Arts, and it lists the requirements. A is a graduate of Portsmouth High School. B is a Portsmouth resident who is graduate. They've still got accredited New Hampshire high school.
Having a tough time getting to page 15. Oh, here it is. Portsmouth.
Yeah, so that one is for the arts at the bottom of that page, and then rolling over to the next page, you got
Yeah.
athletics, higher education, STEM, and trades. They all have the same reference to a New Hampshire accredited high school.
Yeah, well, that's a big difference.
Yeah, absolutely. So we need to, I think, communicate that as soon as possible. I mean, unfortunately, I guess the deadline for students to apply for this is March 15th.
yeah,
So, but we'll, who's the person that,
Brittany.
Brittany, okay, all right. And then,
By the way, the Cogan scholarship was cut off halfway, I think. They didn't finish whatever the sentence was. I've been disciplined at school. Yes or no, please.
which, any idea what?
George T. Cogan.
Okay,
Yeah, that's not one of ours, but
Yeah.
what page is that on?
I didn't remember. I didn't have it. Oh, wait, I do have it 7.
Oh, here we are, okay, I get you. Yeah.
Yeah, it's interesting to see just how extensive this list is and how many we have, how many other people have. It's amazing.
And then my other comment was on the Mortimer scholarships, where they've merged the two into one, and the eligible,
What page?
it's on page 21.
Okay. Yeah.
So the some of those eligibility requirements apply to one of the Mortimers, but not the other.
Yeah, no mention of renewability either.
Right.
no, it does in the other column.
Oh, yeah, right, I see it.
Total funds vary, yeah.
Huh?
Yeah, the total funds vary,
No,
Renewable.
and then renewable.
yeah.
No, it does say it in the third paragraph, too.
Any other? No, the only reason I identified those is because we spent so much time on those two in the last few years, so.
Right.
I did notice that somebody had highlighted
Mail,
mail and
yeah.
then, yeah, and the Kogan one. I don't know whether that means that's being questioned by the
I
legal.
printed this right off of the website,
Yeah.
so I have no idea.
And then later on in the Portsmouth Female Asylum Scholarship, it says it has to be a female. So I don't know whether somebody's looking at those or,
I have no idea. I mean,
okay.
neither one of those are technically the trustee ones, so it's not something that, I mean, it's the first I've seen of it,
Yeah.
you know.
That's quite a name, Asylum Scholarship.
That was not uncommon to name girls' high schools asylums, or what's the one that was in Exeter, had a really odd name, too. All right. Can you relay those comments to her and just,
Yeah.
you know, I think if you give her the letter that we sent, or the one that Peter put,
I'll resend both documents to her. Your
But-
letter and Peter's letter, I'll send them
right,
both.
but, so they need to get to her as opposed to the principal's office, because they probably will
Yep.
not make it in time.
Well, they both got copies of,
That was my understanding, that they
Okay.
both did. It
I
just
handed
didn't
it
make
to
the
both of them.
changes.
Okay.
Yeah.
So it may be just a matter of bringing it to their attention.
Yeah.
And I don't know who actually did this, it could have been somebody else, so. All right, so we'll make those changes. I think the other ones that we're not associated with, I don't think we need to spend any time on them, so. All right. Well, we've got 5 minutes, so you want to jump on to some of the other stuff?
Sure. Sure. Which one would you like me to go with first?
Well, why don't you,
Want to do the checks? The checks?
sure, we can do the checks. Are these scholarship primarily, or?
I've got 3 scholarship checks, and then I've got the Marine Maintenance Trust loan payback check and the budget amount for fiscal year '24, the first half to go over to
Yeah, okay.
city.
All right, well, but we have to approve the proposal before we give them the check, right?
For which one? Fiscal year '24, you've already voted on. And that's the amount that you voted on last February for this fiscal year, so that's.
Yeah, no,
that's
but
that budget.
I'm talking about the marine maintenance one.
Marine maintenance loan, you should probably
Okay,
look
all
through.
right, well, we'll sign them, and then you can
Okay.
release them after, assuming we don't change anything.
was there any push to increase the Prescott Park?
A little bit, we'll talk about it, I think you'll be happy with it, so, I keep in mind where you want to come in, so,
With
cost
This-
of flowers and everything have really, I mean. cost-
Well,
Yeah, gone up.
knowing that there is a big push to have the budget as low as possible, anytime you can increase your revenue,
It's not, I kept everything in mind, I know what you all, it's important for you guys to come in around that certain percentage mark, I keep that in mind. Swap ya. Swap ya. Thank you. Thank you. Thank you.
So will they call in, or how will we know that they're
You're
ready?
supposed to call in like Dana does.
Okay, all right.
Yeah.
We can do the marine maintenance one real quick, so
Okay.
let's take a look at that.
This is easier.
Oh, good. Thank you very much.
So the Marine Maintenance Trust for calendar year of '23 had total revenues of $71,000. There were $1,000 in expenses, and then less the payback to the city of Portsmouth, which is your $22,000, which you voted on last February per the fiscal year '24 budget. And then we like to leave a balance of $5,000 in the checking account. So that's going to allow a payback on the loan of $43,000 for calendar year '23, and that's fairly consistent to where we've been coming in for the last couple of years. We had 45 last year. There's John DeCorto.
Okay, we'll set this aside and come
Okay.
back. Yeah.
Good morning, John.
Good morning, Judy. How are you?
I'm fine. How are you?
Hi, John, how are you?
Hello,
Good
John.
morning.
Good morning.
How are you?
Good.
Are you
Hey,
all by
Hi, Tom.
you all by yourself today, John?
All by myself.
Well,
Is my audio coming through okay?
Yes.
yep, we're hearing you.
Great.
So,
Just let me know when you're ready. I'll share my screen and walk you through the presentation.
okay, I think we're ready.
Okay. Let me hit share here and try to choose the right monitor. Can you please let me know if you can see the cover page?
We can.
Okay, perfect. So with that, I am going to turn to page 4 of the deck. And I also have the January dashboard, but let me, for the main point of the presentation here, speak to the data as of December 31st. So this will cover the last quarter of 2023, and we'll talk about the whole year as well.
Okay,
I'll remind you that all 4 portfolios are identically managed, exact same holdings, exact same weightings. The minute differences that you see in performance on the monthly dashboards is just due to the fact that they were set up at slightly different dates. And so when they rebalance quarterly, it's happening at a different date during the quarter. But I'm sure you've noticed on the dashboards, the performance differentials are, just a basis point or 2. So they're identical composition-wise, and I'll spend the majority of my time just speaking to scholarship. I've got all the other 3 portfolios detailed in here, but all of my comments on scholarship apply to all the portfolios. So we ended 2023 for scholarship at a market value at $11.67 million. Right below that, you can see that from inception, which was mid-2021, the portfolio is now up just under 3% net of your 20 basis point fees. More recently, 2023, the portfolio was up just under 18.6%. And then the fourth quarter of last year was the strongest of the year at just under 10%. And at the very bottom here, you can see that the portfolio is yielding just over 2%. As a benchmark, you can think of the S&P 500 has a yield of about 1.3%. So you're getting additional yield on the portfolios from your roughly 25% allocation to fixed income, plus your international stocks and your U.S. large cap dividend paying stocks give you a little bit of a boost to the overall income level as well. On the right side of the page here, you'll see the asset allocation. So you've heard me say this before, this pie chart uses the color blue or shades of blue for equities and gold and brown for fixed income. So you can pretty much instantly look at that and see you're at a roughly 75% equity mix. And then if you look at the table here to the right of the pie chart, you can see the additional diversification that you have by sector. So the majority of your equity exposure is in U.S. large cap. And that's split between your large cap core exposure, which is a direct investment in an S&P 500 trust, complemented by a roughly 10% allocation to U.S. large value, about a 5% allocation to SMID, a 5% allocation to international, and then you get into the fixed income buckets, and you've got a portfolio comprised of a very modest allocation to what we call other fixed income on this page. This would be your below investment grade, so high yield is obviously below investment grade. Bank loan may not be as obvious on its name. What those are is those are all loans to, they're basically the same kind of loans that commercial banks make, but they're all on a floating rate basis, and they get securitized, and those are all companies that can't issue debt in the capital markets. They're all below investment grade. Those have actually been your best performing fixed income components, although TD currently from a tactical basis is underweight this sector. So your 2% allocation is modest. It's been accretive to your returns, but we're not going to be increasing that in the current environment. And then the rest of your fixed income is split between intermediate and short bond strategies. And then your target cash is 2%, but based on rebalancing and dividend income that comes in through the quarter, that'll creep up a little bit before your next rebalancing. I'm going to show you all the detail on this in a second, but any questions on just the overall asset allocation?
When do you rebalance, John?
So it's quarterly, and if I look over to another screen here, just to give you an example, for example, on the endowment fund, if I go in there, that last rebalanced on February 6th. So that rebalance is on the second month of every quarter. It'll next rebalance in May. Let me just pick one other one just to give you a sense. I picked Prescott. That's also on the 6th and the 8th. I think it was Housing Endowment. Let me pull that one up. They're all really similar. No, that one's also the 6th and the 8th. Did I get all these aligned? I may have done that for you. Yeah, they're actually all now on the 6th and the 8th. So in this case, the differences you're seeing is really just timing in terms of when the system does them, which is really intraday. I'm going to just quickly switch over to your dashboard simply because on one page it shows you, this was for the month of January. So that basis point difference that you see is really just a function then of, did it get rebalanced at 11 a.m. during the day or 2 p.m. in the day? So it would all be intraday. Does that make sense, Dana?
Yep, got it. Thank you. Is the target 2% cash in every portfolio?
Yes, it's the same across them. Yep. And that's actually, Dana, the minimum that the system allows. I don't really have a workaround for that. Although in this environment, going back to the mid-2000s, cash has been a bit of a drag on portfolios. Now it is earning you about 5%. So it's actually a pretty meaningful contributor to the fixed income component. On page 6.
John, excuse
Yeah.
me. So when I'm looking at cash, where do you invest that cash to get 5%?
So for the portfolios, it's in the TD Bank sweep. Actually, you know what? It's one of two choices. It's either the TD Bank sweep or a Goldman Sachs sweep. I can one of the
But it is in some sweep high yield cash account?
Yes, exactly. Yeah. It's not sitting in a checking account earning 20 basis points. Yep.
Yeah. Okay, terrific. Thank you.
Page 6 is showing you the, and I'm sorry I highlighted so much of this to facilitate the discussion, I might as well have highlighted the whole thing, but it's showing you each of these lines is one of your individual holdings. And so you can see the holding on the left, you can see the manager percentage. The start date here, I'm just showing you, I'll show you the full year on the next performance slide, but on this, I'm just showing you the third quarter as an update to our last meeting. So this is from September 30th through the end of the year. And as you look at the far right here, these were returns just for the fourth quarter. Really strong returns down the line. Your strongest return is actually at the very bottom here, which is your SMID cap exposure, was up almost 15%. After that, at the very top, you got the S&P 500 at 11.5. The 10% allocation to value stocks was up 9% last quarter. International were up 9%. Fourth quarter was just a strong quarter overall. And then in fixed income, I highlighted your two intermediate bond strategies. Your longest duration strategy, this pure corporate bond strategy, and this is all investment grade, was up almost 10%. And then your longest duration treasury strategy was up over 6%. So you're not, none of these corporate bonds are paying coupons of 9%. Your coupons probably in the 4% range. But we had a big drop in interest rates in the fourth quarter. And so I'll remind you that bond prices move inversely to interest rates. So the figures you're seeing here is the total return. So it's your coupon income plus the increase in prices over the quarter. And what happened in the fourth quarter was the Fed essentially signaled that they were done tightening. The market almost immediately started pricing in the first Fed rate cut, and we actually saw a dramatic fall in the middle part of the yield curve, as much as 60, 70, 80 basis points. I'll show you that in a few slides. So that was a big boost to the returns in the fourth quarter. And then I mentioned high yield. It's a modest exposure at just 1%, but even high yield. Now here you actually are getting coupons in the 7 to 8% range, and so 7% yield on high yield. It's kind of been consistent all year round. Just a little more detail on fixed income. Your portfolio is roughly, again, this is 25% of the portfolio. It's emphasizing U.S. Treasuries. And you can see that in, you've got a 7 to 10 year Treasury strategy, a 3 to 7 year Treasury strategy, and a 1 to 3 year Treasury strategy. So I've got even basically like a 1 to 10 year Treasury ladder for 15% of your fixed income exposure. The balance is in investment grade corporate bonds, and then that 2% allocation to high yield. Overall, you've got a single A average credit rating, so very high credit quality, and your duration's about 5 years. Kind of a classic intermediate duration. There's going to be periods where rates rise, and that will benefit you. That's actually been the case so far this year. There will be periods where rates fall, like we saw in the fourth quarter, where you would have been better off in a slightly longer duration portfolio. But as I'll show you in a couple slides, you've been well positioned. So this chart is now not showing you performance by product, it's showing you aggregate performance. This is as of December 31st. So in the fourth quarter, as I showed you on that first page, you were up 9.88%. We can compare that to the City of Portsmouth IPS benchmark, which is pretty closely aligned with your policy. I noticed one difference today that interestingly makes this number more favorable than it would otherwise be, but that's okay. I don't mind the way we have this. But the differential you see here in the fourth quarter is precisely the fixed income duration that I was mentioning. The fixed income component in the benchmark that's shown here for your IPS is just the aggregate bond index, which has and that was up about 7% in the fourth quarter versus about 5.5% for your shorter duration portfolio. Purely the math associated with interest rates falling in the fourth quarter. If you go down to the entire calendar year of 2023, you'll notice your portfolio was up 18.57%. Again, that's net of the 20 basis point fee. And that was versus the IPS of 18.15. So in that case, you really got the benefit of a couple of things for the year. You had, you didn't you didn't suffer from a duration adjustment with regards to fixed income. That was pretty much neutral. And then with regards to equities, you have a lower allocation to international in your portfolio currently than is in the IPS. It's about 10% less in your portfolio today. There's no emerging market in the portfolio, whereas the IPS benchmark has a 5% allocation. So that explains the outperformance that you saw last year. Now, I'm not recommending, and then sorry, lastly, I just highlighted at the very bottom the inception to date performance. So you can see that we started this portfolio in mid-2021. 2022, you'll recall, was a disaster of a year for both equities and fixed income. Fixed income indices were down 8 to 10%. S&P 500 was down 18%. So 2023, got us back into meaningful positive territory. And again, the positive differential that you see to your IPS between these two numbers, the 288 and the 239, is really the same as 2023 with regards to lower exposure to international. Now, there's going to be quarters where, international does quite well, and you'll see the opposite. But your portfolio today, I'm not recommending any changes to the allocation. Your portfolio is consistent with TD's current tactical views, and I'll show you a slide on that. But in preview, we're slightly defensive on equities, and that's why we've got that allocation to U.S. large cap values, a little bit more conservative segment of the equity market. We like U.S. over international just based on, we kind of see slowing growth through 2024, both domestically and internationally, but we think the U.S. is better positioned. And we've got a preference for higher quality assets and fixed income. So as I mentioned previously, U.S. Treasuries, kind of first and foremost, investment grade corporate bonds over high yield, and that's reflected in your current allocation. With that, if I turn to these pages are just showing you again, same composition, but just showing you the snapshots for the other three portfolios. All of your portfolios are higher, just to use this as Prescott, 6.25 million at the end of December. You saw the January snapshot where Prescott was 6.3 million, so up about 50,000. And just for reference, we're obviously coming off a very strong day in the markets. But let me just tell you, Prescott was 6.497, call it 6.5 million yesterday at the close, so up a couple 100,000. So just this month alone, the markets are up a couple percent. Jumping back to the main deck, let me get you to the market update here. So in 2023 was a surprisingly good year, particularly for equities. You can see fixed incomes at the top of this page. I highlighted the U.S. Aggregate Bond Index. So this is investment grade corporates, U.S. Treasuries, mortgage-backed securities, and your money market instruments like asset-backed commercial paper, securitized auto loans, credit card loans, things like that, all the asset-backed securities. So for the year, it was up 5.5%, which is, I'll remind you, in 2022, that index was down over 8%. And so if you look at 3-year returns for the aggregate bond index, still meaningfully negative. You got to go back all the way 5 years to get to positive 1%. But again, this is a function of the Fed raising rates the most aggressively as we've seen in our lifetimes, primarily in 2022. In 2022, they took the Fed funds rate from 0.25% to 4.5%, and then last year they took it from 4.5% to 5.5%, so a 1% increase in rates in 2023, and it was all at the short end of the curve. The market had actually, this is coincidence more than anything else, but the market had pretty well priced in what the fixed income markets were going to do about a year in advance, and I'll show you that in the slide. So even though as I've told you before, rates go up, bond prices go down. It was really only the short end of the yield curve that went up, so it wasn't sufficient to offset, these nice higher yielding coupons that we're all getting in fixed income. You'll notice if you look one line up that the Treasury index was up 4%, and one line down, the corporate bond index was up 8.5%. That's a unusually large difference in the spread between corporates and treasuries. The reason for that is spreads, as we call them. The spread, the additional yield that investors demand to loan money to, Coca-Cola versus the U.S. government, that spread decreased dramatically in 2020, almost 100 basis points in 2023. So that's the equivalent of rates falling for corporate bonds if investors are only going to demand a 75 basis point spread over treasuries versus 175. And your 10% allocation to corporates definitely benefited from that. And then at the very bottom, I didn't highlight this, but it just shows the dramatic outperformance of U.S. high yield. Now, this is by far the riskiest segment of the fixed income markets. These are all below investment grade corporations, and they've just benefited from the fact that the U.S. economy was much stronger last year. TD was never officially in the recession camp, but we were pretty cautious on equity markets, and we and everybody else, and I'll show you in a couple slides, just the strength of the economy really surprised everybody. That most demonstrably benefited lower rated issuers. Again, TD's underweight high yield going at the current time. One of our concerns there is, we know that corporations by and large termed out their debt when rates were below 1%. Those term loans are starting to roll over now. So this is a big question mark going forward is the refinancing wave amongst these companies going to handcuff them when they're refinancing from 2 to 3% rates to 8% rates? Time will tell, but you've benefited from your modest high yield exposure, and there's no reason to lose any sleep over a 2% allocation there. So we'll see how that plays out. In equities down below, you can see here on the 3-month column, so the fourth quarter of last year, which we went over, very strong across the board. S&P 500 up almost 12%. I highlighted the growth style category within U.S. large cap, 14%, and the value category, 9.5%. So growth outperformed in the fourth quarter, and if you look for the year, one column to the right, just an absolutely shocking outperformance by growth of 42% versus 26% for the S&P 500 and 11% for value. Interestingly, if you go one column to the right and look at the 3-year returns, 10% for the S&P and 9% for growth and value. The reason these are so close is 2022 was just a disaster for value stocks, down close to 40%. So 2023 was essentially a reversal of 2022 in many ways. At this point in time, looking forward, TD's a little cautious on equities. It's largely based on the fact that a small segment of stocks has been driving equities forward, and that's, you've probably heard the term the Magnificent Seven. So this is Google, or Alphabet as their name is, their official name, but it's it's what we think of as Google. Microsoft, Apple, Tesla, Amazon, Nvidia, and I'm missing one. Which one is it? Bear with me.
Meta.
Oh, Facebook. You'll recall, I think in our third quarter meeting, I showed you a chart that showed that those 7 stocks were responsible for 75% of the S&P 500's return. They now comprise about 30% of the index. Historically, we've seen this before, and much of this is just absolute euphoria over artificial intelligence. the market just can't get enough of NVIDIA, whose computer chips are largely in demand by the other, by the Googles and the Amazons and the Apples and the Microsofts to power their artificial intelligence capabilities. We don't know yet how, it's certainly benefiting NVIDIA in terms of the demand for their chips. We don't know how it's going to play out in terms of productivity growth or profitability for these other companies. I'd mentioned three cautionary points. One, if you remember this far back in market history, we had this segment of companies called the Nifty 50. This is going back to the late 60s, early 70s. It was an absolute fascination with all things electronic, as well as U.S. large cap blue chip companies. McDonald's is a great example. Throughout the 70s, McDonald's profits and growth were like 20% plus a year. It did phenomenally well, but its stock, I think, fell in half during that period of time simply because it was just so overpriced going into the decade that the market decided, it wasn't worth 90 times earnings, it was worth 25 times earnings or 20 times earnings. You may recall that the P ratio, the price to earnings ratio of the overall market tends to average 16, 17, 18%. So right now, NVIDIA is trading at almost 100 times earnings. Amazon's trading at 60 times earnings, Microsoft and Apple about 30 to 35 times earnings. I mean, these valuations look a little bit stretched. So, TD's call is actually that fixed income may do better than equities over the next 12 months. Now, keep in mind, we've been saying that for about 6 months, so we've had to kind of keep pushing this off, but we're now at a point where, we just don't think U.S. growth is necessarily going to support this level of concentrated equity returns. That said, I'm not telling my clients to go from a 70-30 portfolio allocation to 30-70. Obviously, for portfolios like these with your perpetual time horizons, that wouldn't make sense, nor do we have a crystal ball you really got to get the timing right to do that. But we'll see how it plays out. Again, the mania around AI seems to have investors rather euphoric about these handful of stocks. Apple's not growing at 35% a year anymore, neither is Microsoft. And then interestingly, I don't know if any of you have played around with any of the kind of the AI apps that we can use, but there are arguments being made now that it could be a real threat to Google's dominant search engine. There are apps now. I just downloaded one the other day. It's the ChatGPT app, and you can ask it to write you an essay on the French Revolution, and seconds later there it is on your phone. It's just astounding as to how that gets monetized. I'm not exactly sure, but the competition for eyeballs in this space is dramatic. So the market has yet to seem to price in the fact that competition will continue to rule the day, and there may need to be some reassessment evaluations here. But that said, this is why you've got the diversification you do. This is why you're not 100% in U.S. large cap growth. And in fact, the S&P 500, by virtue of you've heard me mention before, the S&P 500 is a cap-weighted index, meaning when you put $1 into it, it doesn't get split equally across the 500 names. Roughly 8 cents goes to Apple, 8 cents goes to Microsoft, 7.5 goes to Amazon. It's weighted by the size of these companies, so they keep benefiting from the flows into the index, and as a result, the S&P 500 itself kind of has a growth tilt to it, and that's part of the reason too that we've got the allocation to value for you, as well as in the SMID and international space, because you've got to have that diversification. I think your portfolio is probably the highest performing of any of my clients. Your approach to embracing ETFs and really just trying to capture the performance of the indices has been by far the best performing strategy. And this is going back 15 to 20 years now, so it's really served you well. Turning to page 15, I'll just spend a couple of slides on fixed income. So just focus on the line graph over on the left. What this is showing you is a graphical depiction of the yield curve So if you look at the x-axis, it's 1 month U.S. Treasuries out to 30-year U.S. Treasuries, and it's 3 points in time. And if you just look at the blue line and the green line, the blue line was the end of 2022, and the green line was the end of 2023. So this is a graphical depiction of my comment that at the end of 2022, the market got this pretty right. The short end is always going to move with what the Fed does, and it went up about 100 basis points last year. But the long end had really factored in that whole move quite accurately. Now, this is just a point-in-time snapshot, so it's not like the forward rates rarely turn out to be where interest rates are in the future, but for this 1 year, year-over-year snapshot, that's exactly what happened. However, only 3 months earlier, if you look at the gray line, this was the yield curve at the end of the third quarter, mid to long-term rates were meaningfully higher. And if you look at this second column from the right, you can actually see the basis point change. 2-year rates dropped 80 basis points in the fourth quarter. That's a huge move to get to where we ended the year. And that was a function of the Fed coming in and saying, we think we've reached the end of our tightening cycle. We think we can kind of wait and see and assess the markets. And historically, when the Fed is done tightening, a rate cut tends to come within 6 to 9 months. And the market kind of immediately priced that in. Page 16 is showing you just the Fed funds rate. So this black line here is just the very short end of the yield curve. It's the overnight rate that banks charge each other. It's the one rate that the Fed directly controls through their policy setting. And so we have been at 5.5 since July of last year. This green dotted line is TD's forecast. The gray dotted line above it is the Fed's current forecast. So you can see TD over the course of 2023 has got a 100 basis point cut priced in, slightly more aggressive than the Fed. And that continues through 2025, and that's where we see a pause in an easing cycle. Don't overthink this. We don't have a crystal ball. Neither TD nor any other major Wall Street bank that I follow got the magnitude and timing of the tightening cycle that you see here, right? Part of that is a function of we've never seen that before. And so, is it going to play out this way? We don't know. I'll show you our GDP forecast later on, but we're looking for, really what we and pretty much everybody else is looking for is, the economy went through an unprecedented period of time with the pandemic and the lockdown. It was followed by still almost an incomprehensible amount of fiscal and monetary stimulus by virtue of what we did with payroll protection loans and checks direct to consumers, bringing interest rates down to zero. We've never seen a combination of fiscal and monetary stimulus like that before, and it caused everybody to essentially underestimate the strength of the economy last year. But there's no reason, absent additional stimulus, everybody's forecast is for slowing growth through the first 6 months of this year before finally picking up. So that's really going to drive what the Fed does this year, combined with does inflation continue to fall, which is still above their 2% target. Moving over to equities, this is a really interesting chart. So what this is showing you on the left-hand side is that all the sectors, as we divide the U.S. economy into sectors, communication services, discretionary, information technology, real estate, etc. The S&P 500, the aggregate is in the middle here in black. But the blue bars is 2022 performance. The green bar is 2023 performance for the same sectors. And it's practically a mirror image with the exception of the very bottom. You can see energy was the outperformer in 2022 and down slightly in 2023. But this speaks directly to what I was saying earlier about those 7 stocks that have benefited tremendously from the trends since the pandemic and continue to do so. So communication services is where you get Google. Consumer discretionary is where Tesla and Amazon come in. Information technology is and actually Facebook is in communication services as well. Information technology gets you your Apple, your Microsoft, and your NVIDIA. So, that this looks a little euphoric to us again. The thinking that artificial intelligence is going to transform the world right now is just being expressed in positive terms. I'm definitely a glass half full, very optimistic about the future investor. That said, one of the offsets of AI is replacing humans in jobs. So there will be winners and losers as a result of this technical revolution we seem to be going through right now. A little too early to see how it plays out, but it's really difficult to come up with jobs that can't be somehow negatively impacted by the strength of AI. So again, always winners and losers in the economy. Right now, the winners are definitely leading the pack. I mentioned earlier that the market really surprised people last year, and it was largely a function of actual S&P 500 earnings pretty dramatically outpacing the estimates. So in each of these four quadrants here, you see the 4 quarters of last year, and the blue line were the estimates. Wall Street estimates for S&P 500 earnings, and the green bar is actual earnings. So even though earnings were down year over year in each of the first 2 quarters, they were significantly better than the market had forecasted. And then the third quarter last year was a huge blowout, and then everybody had to revise their estimates for the fourth quarter. So we haven't seen full S&P 500 fourth quarter earnings yet, but based on what's coming in, it should match or slightly exceed these figures. And so that seems to be the main explanation for the strong equity returns last year. I think it's the next slide. Yeah, perfect. And then there's 2 other variables, one of which I have a slide on. So these green bars are showing you U.S. household deposits. And, this is a trend going back to 2010. Nice growth that you see here in sync with the U.S. economic growth, kind of flatlined during the pandemic until the response to the pandemic and the stimulus. Massive, absolutely massive increase in the trend. Economists just didn't have models to really account for how this was going to get spent, but we now know, based on how well the economy did last year, in defying expectations for a slowdown, if not a recession, there is still 1.3 trillion in excess savings. That's where we are here. However, at the rate at which it's being spent, we expect it to be depleted by the second quarter of this year. So it's just, this is why we're cautious. We're not seeing a huge spike in where the growth is going to come from this year. The other factor being there's always a lag with respect to the Fed increasing rates and it then working its way through the economy. And, we think that still has to play out. That said, and I don't see, in my opinion, nearly enough people talking about this, people think of the Fed raising rates as restrictive. But if you've got all this excess savings, and let's think of let's just think of a 3-month Treasury bill. Back in 2020, if you had $1 million 3-month Treasury bill, you were earning $2,500 a year on that $1 million riskless investment. Today, that $1 million is earning you $52,000 a year. I mean, there's a lot of people with $1 million in treasury bonds. There's a lot of corporations with significant levels of cash. And so I don't expect that any of you, like me, listen to modern monetary theorists like Warren Mosler in your free time. But he's a really interesting economist. He is of the strong opinion that while we think of raising rates as being restrictive, in this environment, when the U.S. government total debt to GDP is over 100%, raising rates is like a pay raise for the wealthy. And and they're spending the money. And so it's just, we don't have great data on this yet. It'll be interesting to see if people try to quantify it, but it certainly does make sense. And it seems to be a reason for the unexpected strength of the economy last year. That said, while we don't see rates going up much more than they are now, and clearly the spending can only go so much lower. So we'll see how that plays out. Again, just in numbers, this is our rate forecast. So we're at 5.5% today for the Fed. We see us getting to 4.5% by the end of the year. Interestingly, as you just go straight down this line where you see the 2-year Treasury and the 10-year Treasury, we still think the curve's going to be inverted. And that could change quickly if the economy slows down more dramatically than anybody's predicting. But for now, this is the consensus forecast for us. And if you go down to the table below, you'll see how that translates into really pretty modest real GDP growth. Okay, so you might see headline numbers of 3 or 4%, but adjusted for inflation, under 1% until you get to the fourth quarter. And then at the very bottom, our forecast for the Consumer Price Index, we think even by the end of this year, the Fed still won't be at their 2% target. And this is another really tricky one. You can ask 10 economists to define inflation and you'll get 10 different answers. The Fed often speaks to 3 different inflation benchmarks that they look at. For your average American who is struggling to keep up with the price increases and is living paycheck to paycheck, the Fed has got to get these increases in pricing down. And then they seem to be doing quite a good job working their way towards it. What we don't know is how sticky the price increases that we've seen to date are. Are we going to get back down to 2%? And then secondly, if you were to ask me, what's the biggest risk in this forecast over the next 12 months, I would tell you it's this bottom line. With what's going on geopolitically, we've got a war in Ukraine that doesn't seem to be slowing down. We've got rebels attacking oil tankers in the Persian Gulf. If we get a disruption in energy supply, and a spike in energy prices, that's going to make it very difficult for the Fed to cut rates as we're forecasting here. And seemingly in the short term, probably negative implications for the economy. That said, we've been living through this environment for over a year now and getting by just fine. But when I think about what the biggest risk to the 2023 forecast is, I always come back to inflation, because that really ties the Fed's hand in terms of the flexibility that they might have. I think I just had one more chart here. Yeah, I just wanted to leave you, and I'll kind of come back to what I mentioned when we were talking about the portfolios. So your portfolios today, not making any recommended changes, your portfolios are aligned very nicely with TD's current tactical views in fixed income, which is here in the middle column, emphasis on the more liquid and higher credit quality subclasses, which you already have expressed in your portfolio, as well as investment grade over high yield. You've got a very modest allocation to high yield, which has actually benefited you. And then in equities, we're a little cautious here. Companies with defensive traits, so largely think U.S. large cap. Preference for U.S. over international developed, and in the last column we anticipate better opportunities ahead. The thing we're concerned about in stocks here, if our GDP forecast is correct, is that historically periods of strong equity performance that have been highly concentrated, as we're seeing now with the 7 stocks that I mentioned, typically do see corrections. And so, our crystal ball isn't clear enough to be able to predict precisely the timing of that. But you do not have a oversized bet in any one direction as it relates to the U.S. stock market. You're well diversified across both style and geography, and you have been perfectly positioned to take advantage of the strong markets that we've had. So again, I go back, I say, what was your performance last year? Yeah, almost 18.5% net of fees. I think that's the highest amongst my clients with this level of asset allocation. So it's the whole strategy, and your preference for passive, which goes back to when we built the portfolios, has really served you well. Sorry, I know I talked for a long time there, but happy to answer any questions that you have.
So I have one question, John. Can you hear me?
Yes, I can hear you great.
I thought I heard a little echo. So your nervousness about equities doesn't suggest that we should reduce our 75% position to 70 or something? You just think it's changing the mix of the equities?
Yeah, so because I would recommend a change if you were, if you had an overweight to technology, or if you had an overweight to the growth style segment, that's where we're a little bit cautious, but you don't. You've got that 10% allocation. We're neutral on kind of the overall U.S. market in terms of style preference, and you are expressing that through the S&P 500 allocation that you have, plus that 10% allocation to U.S. value.
Okay. Other questions?
Can I suggest a housekeeping item, just because we'll probably
Yes.
send this to the Attorney General's office? Do you want to have the trustees vote that you agree to accept, that recommend no changes at this time, or up to you, Tom?
Yeah, no, I do have another question. I was looking through my files before coming in here, and I noticed the last time we really looked at peer performance, peer group performance, it was in fall of '22. So I don't expect you probably have anything with you today, but would you have any sense as to what our peers have done in year-end December 31st?
So, yes, although nothing scientific, by which I mean of the, if I define peer as other New Hampshire trustee of trust fund portfolios, it ranges from all fixed income to a 75% allocation to stocks. And yours isn't the only portfolio that I have with that allocation. I have one other client, 75% in stocks. That portfolio has had a strong preference for dividend-paying stocks. Their philosophy has been, all we can spend is the income. And coming out of the long period where interest rates were so low, dividend-paying stocks were kind of maximizing their yield. So their objective is different in that portfolio, even though their allocation to equities is the same as yours. They've been almost exclusively in the value bucket, so their total return has been significantly less. They're generating more income, but the total return of their portfolio has been much less. The ones that are all fixed income obviously have generated significantly lower returns. And then when I had done some work for you, you had shown me some data from some larger portfolios as a benchmark. I know I don't have the details in front of me, but I remember providing some of that data to you as I looked at it. I didn't find it terribly useful in the sense that one of them might have been the New Hampshire Investment Fund. These were really large funds that had allocations to private equity and things that just weren't apples to apples, and based on the data that they provided, the time periods didn't match up. So it made it really difficult to kind of provide a meaningful comparison. But at a general level, just by virtue of the fact that you have focused on passive ETFs, that alone is driving outperformance for you. I'm not saying that no active manager is outperforming, but it is. Let me go to one other chart here. This one with the sectors. active managers are finding it extraordinarily difficult to outperform in this market, and hopefully this point will resonate with you. One of the reasons is active managers who always want to be focused on diversification and not taking any outsized bets in any one company tend not to have more than 3 or 4% max in any one name. Most will have 1.5 to 3%. And as a result, you may recall me mentioning to you earlier that in the S&P 500, Apple's got an 8% weighting, Microsoft's got an 8% weighting, Amazon's got a 6% weighting. By definition, active managers, if they're sticking to like a max 2 to 3% allocation to any one name, are significantly underweight what is currently the best performing segments of the market. Now, that could reverse in a correction, but your strategy of sticking with the indices and holding on through 2022 and then benefiting from the rebound in 2023 has really positioned you, like I said, I don't think within my universe of clients with this asset allocation, I'm sure nobody's doing better. The only way you could have done better last year would have been to have overweighted the growth style. And that's a tactical call where you're never going to get the timing exactly right on the front end, and you won't get the timing right when it's time to sell. So we've taken a more balanced approach. But I'm sorry I can't give you really strict hard data on that. In part because I have such a diversified portfolio list amongst my trust fund clients, because the asset allocations are so different. But within a 75-25 mix, you've got to be in the top decile.
Okay, thank you. Yeah, the last time you did this for us was in October of 22, and we had that problem at that point because we were looking at like New Hampshire Charitable Foundation and its
Right.
equivalent in Maine, and as you said, they're different creatures. But I was just curious if you had that information. I remember there was also some issues that some reported out on a fiscal year, others reported out on a calendar year. We lost you, John. Are you still with us? There he is.
There you are.
I'm so sorry. I intended to stop sharing my screen so you could see me, and I accidentally hit the leave button.
No worries.
I didn't miss too much there, but
So what I just was sort of reaffirming your observation that when we were doing the peer review analysis a little over a year and a half ago, that you had difficulty coming up with true peers in the sense of
right.
the types of a lot of the trust, I believe, were smaller. The trustees of trust funds accounts were smaller than us, but the statewide aggregating charitable foundations were significantly larger. So that just changed the management in each of them.
Exactly. There were allocations to private equity, there were allocations to funds of funds and hedge fund strategies, which definitely aren't apples to apples. Interestingly, what you could pull out of some of that data was they showed their equity performance, which you could compare to the S&P 500, for example, and if I recall, in most cases, their active performance was lower. And so again, your investment in the indices has served you really well.
Okay. So let me just ask you sort of on the record, because we'll take a vote on this. So is it your opinion that we stay the course with our existing investment policies and allocations?
Yes, it is. Yep. Your portfolio is currently constructed in a way entirely consistent with TD's both long-term strategic views and our current tactical views.
Great. Other questions of John? Well, this has been very helpful, John.
Pretty good with you. Terrific.
Great. Well, great to see you all this morning, and I will hopefully we'll be in person next quarter.
Just make sure that the next 11 months are as good as the first month.
Yes, that would make my job a little bit easier, but that's all right. We'll react and be prepared for whatever environment ensues.
Very good.
You know,
Thank you all.
Great.
Thank you, John.
Yep. Take care.
So, consistent with that, I would entertain a motion that we continue our existing investment policies, including our allocations, consistent with the policy that we adopted a few years ago.
As recommended by our financial advisor.
Exactly.
So moved.
Do we hear a second?
Second.
Okay, any discussion on that? Hearing none, I'll call the question. Peter?
Yes.
Dana?
Yes.
And the chair votes yes. Okay. Now let's go back to the Marine Maintenance
Trust.
Trust. So in essence, what you're proposing is what we do each year, which is set aside just a small amount to sort of carry over until the income starts coming,
That's correct.
and use the rest to pay down the loan.
Correct.
Okay.
Correct. And with that pay down, the loan will have now be at $296,760. It originally started at $631, so within the past 10 years, we've almost cut it in half, so that's where things stand.
Okay, well,
Based on that, Judy, when do you anticipate you can pay the whole loan off?
We have to earn the
Another
money.
10 years?
Based on that, yeah, it'd be about another 10 years if we continue operating the way we currently are operating.
yeah, well, you figure if you get about 300,000 left, and we're paying it down at 40,000 to 45,000 a year,
Yep.
you know, it's that interest rate that's killing us. Well, we should take a formal vote to approve this distribution. I'll entertain a motion to do that.
So moved.
Second.
Okay, any more discussion on the summary and the proposal to pay the $43,000? Hearing none, we'll call the question. Peter?
Yes.
Dana?
Yes.
And the chair votes yes.
Thank you. Okay. And next, if we just want to go right into the
Yeah, into the Prescott Park.
payback, Prescott Park. Yep.
If you have one of those enlarged, we'd appreciate it over on this end of the table.
I know my people.
You either has to give us
Very much.
better printers for home use. Judy.
Now,
That is not in my realm.
What is this? Is this, this is bigger than legal.
11 by 17,
Yeah.
yes.
You can't do that.
Yeah. So,
so we're looking at the city's budget for the park.
budgeted, right, correct.
Okay.
The budgeted amount that was approved for, by the trustees for fiscal year '24 was a total of $227,000, $204,000 from Prescott Park, $23,000 from the Marine Maintenance Trust. The check that has been put before you today to be signed is for half of that amount. And as you can see by the expenditures through the first month in the third quarter, the money is being spent. It's time to make that initial first half deposit, and then in June we'll come in for the rest of it, based on what's been agreed upon. So.
So Judy, this was the expenditure detail for fiscal year '24, which ends
Current.
June 30th.
Correct.
And what you're proposing is to release the remaining 113,500.
No, I'm proposing right now to do the first half of it. We haven't released anything yet, so I'm proposing that we'll release the first half of the money, and then, as we did last year in June, we'll
Okay.
come in for the
I
second
get it.
half of the money.
And that's on the current budget,
Based
Yeah,
on what
we're
we're
going to get to
currently
the next
operating
one.
on.
right?
Yeah.
Yeah.
All right, yeah, okay. And so these numbers are as of today or as
As
of
of June, January 31st.
January 31st? Okay, all right. I was going to, I was
So as you
wondering.
can see, if you look at the total, down at the bottom in the total column on the far right, we're at a negative 96,000. That's because we haven't received any funds in from the trusts yet. Once we get those funds in, it'll take us to where we expect to be. We're only in the we're only halfway through the Q3. Q4 is very active for Prescott Park. We know that we'll end up using all of the monies. We always do. I've seen the encumbrances, quite frankly, for some of the flowers and stuff. There's money sitting out there ready to be spent to start getting the park going for May and June, so. But this is just for the first half. Usually we come in for two halves. This is the first half.
Well, so far this year, they've spent 273,000?
That is correct.
All right. And so the $96,000 figure assumes we're making this payment?
The 96,000 is, if you look up in the top, we've only collected so far 177,000 to date in revenues. Once we bring in the first half of the year for the Prescott Park Trust, that will help with that deficit.
Well, that will be more than cover that deficit.
It will, but again, we're spending as we're going, so yes.
Okay, well,
Yes.
the only reason I'm asking the question is
Yep.
we can only spend on approved, we can only pay against approved expenditures. And there's, I'm trying to figure out, are we issuing a check for 113,000 against 96,000?
Currently, yes.
Right. So we're actually,
No, the expenses are not are more than the 96.
well, that's what I'm assuming that
Yes.
273,000, but.
That is
that's-
correct.
We're short 96.
Yeah.
Or,
Currently, if we wanted to come out to zero as of January 31st. Now, again, we're halfway through February, so that deficit is more now.
Okay, well,
What we've always done is done half and then half.
well, the other question would be, wouldn't it be better for you to come in January?
It would be, but it just didn't happen this year.
Okay.
Usually I do come in
And
June.
that way there, it's a 6 month.
Correct. That is correct, Peter. That is, it just didn't happen this year, so
Okay.
I'm coming in a little late.
okay. So,
I'd move the approval request.
and that's to pay down or issue a check to the city from the Prescott Sisters Trust for $113,500.
Prescott Park is 102, and then 11.5 is from Marine Maintenance Trust for a total of 113.5. Yes.
Okay, is there a second to that?
Second.
Okay. Any further discussion? Hearing none, we'll call the question. Peter?
Yes.
Dana?
Yes.
And the chair votes yes.
Thank you.
All right.
make this be a little clearer for you all with the color. I don't know if that helps or not. The 5-year rolling average, you got it already in that.
Yeah.
Is mine clearer or yours not?
This is a little clearer.
Okay.
Okay, want to walk us through this?
Yes, so, as you know, every year, the city of Portsmouth comes in and requests some monies be allocated from the Prescott Park Trust and a little bit from the Marine Maintenance Trust towards the upcoming budget. So we're looking currently at allocating some monies or requesting to allocate some monies into the fiscal year 25 budget, which the city is currently preparing. It's based on the 5-year rolling average, which has, it's been done that way, I think, for a long time, hasn't it, Tom? 5-year
Yes,
rolling
yep.
average, yeah. So,
This is the exception to the rule that was approved many years ago with the AG's office.
yes, yes. So, based on the policy guidelines, currently, as of December 2023, the fair market value in the fund was $6.25 million. And then if you come down, your rolling average for fiscal year '23 was that 6.25. Excuse me, the 5945 is your
The one in
rolling
the
average.
bright yellow, yeah.
Yes. So based on that are the scenarios down below for the requesting based on percentage. The first one is not to exceed 4%. So if you gave 4%, that bottom line projected budget funding would be $237,000. Last year's average was at 3.625%, for a total of $215,000. My recommendation is, and in discussions with you in the past, you want to keep that percentage low. I'm recommending 3.5%, which is lower than last year's, but it still gives a little bit more money than what was done the previous year, which was 204. So it's kind of, it helps the city out, but it still is continuing to keep that average low. Actually is lower than the previous year. And then Marine Maintenance Trust, we're requesting 25 versus 23 just because the cost of operating docks have gone up and the city could use a little bit more help in the funding with that as well.
Is that for labor?
Labor, the cost of the DOCWA, the computer system to do the reservations has gone up. That went up significantly. So, it will help out. And I don't think because the rates and the seasonals went up this year, I think the offset will still be, you'll be able to make that $40,000 to $45,000 payback on the loan while still being able to increase the marine maintenance a little bit to help out. So my recommendation is that blue column at the 3.5% for a total amount of money to come over at $208,000 for the Prescott Park Trust and the $25,000 for marine maintenance.
208,100.
100, excuse me, you're correct, Peter. You're correct. I stand corrected.
So move.
Do we hear a second?
Yeah, second, this is great work. Thank you.
Well, this is also, it's great that we can gradually lower that figure, because you'll recall, Dana, we were paying, almost 4.5% at one point.
Yeah.
Oh, yeah.
And so,
Well, you call the question, then I got a question for Judy.
okay. Was there any further discussion on this in the proposal? All right, so the proposal is that we will pay 3.5% of the 5-year rolling average, which totals $208,100 to the city for contribution toward the expenses associated with the operation of the park.
Well, it's 233,100.
Including the 25,000.
Well, okay.
Yeah.
Plus the marine maintenance, yep. So $233,100. Call the question. Peter?
Yes.
Dana?
Yes.
And the chair votes yes.
Okay, Judy, with that contribution, what is the city now having to budget to the operation of Prescott Park?
Currently working
Last
on
year
that.
it was 568.
Yeah, and it's more than that this year. It's gone up, I want to say the general fund's contribution is going to be roughly around an increase of 9% to continue the operation.
It should be how much?
It was, what,
68.
568 last year, yeah. So, and it is going up.
600,000.
Right.
It is going up. Again, working on the budget right now, so not a hard number yet, but coming soon. Yeah. Yeah, and a lot of it, everything's gone up, as we know, flowers, just the overall maintenance, gasoline, electricity, everything has gone up, so, and we expected that. I think Peter Rice spoke to that, several times, in the fact that, there have been certain things in the past that Public Works has just been kind of picking up, and now they're trying to document it more so they really can reflect the true cost of how much it costs to operate that park. So, and I know that's Peter's goal.
Is the festival or the Gundalo, are they contributing?
They are.
that?
They are. They have lease agreements, and they are contributing. We're currently working with the city manager to determine the amounts on that. But yes, they do contribute. And some of that's based on, their financials, what the city does get in reviews. So, but yes, they do contribute as well.
It's just a good thing for people to know what the actual cost is to operate the park.
Agreed. For years, the trustees made it work with what they had, and Michael Warhorst was a workhorse and did above and beyond, So, but yes, so thank you for that. City thanks you for that.
Well, plus with the flooding and stuff that is happening, they had to replace the furnaces
Yeah.
in the Shaw.
Yeah, right.
Yeah.
I mean, that's not insubstantial, so.
No. So,
Okay. Anything else for us, Judy, on the financial stuff?
that's it.
And nobody snuck in my absence, so I will entertain a motion to adjourn.
So move.
Do we hear a second?
Second.
All in favor, Peter?
Yes.
Dana?
Yes.
And the chair votes yes.
And the next meeting is in Florida, Dana?